And that means we are here live on our YouTube channel, Tackle Trading's Halftime Report. Welcome out to our show, as always, everybody. As you pop in and you join us, if you are a veteran of our community, you know the hashtag Team Tackle, pop it in the chat. As always, give me a thumbs up as we go if you're enjoying our content. And if you're new to our channel, as always, subscribe, click the bell. We do this show each and every day. Got a full crew here today. We've got Noah, Cody, Mark, and Matt all on the back end. Guys, everybody, I'm assuming, is doing great. Everything is awesome. Everything is great. Markets are just kind of doging here today. Matt, how you doing, brother?
I'm doing good. Excited to be here with the crew.
No, I got you on screen share. We're going to get your thoughts here in just a second. Marky, you're in just an optimistic mood, I'm sure, today, right?
Dude, yeah, I mean, I think you got a really clear read of this market right now. There are companies, and we'll get into it shortly, but there are companies that people love, and there are companies people don't. And it is really separating this week. And, you know, before you saw these movements where everything was up or everything was down, and you've really seen it. We've been talking about it all week. Just there are the market darlings that people feel safe, feel good about, and there's everybody else.
Yeah. In fact, Noah, why don't you go to a heat map first? I actually think there's a really good point. We're going to obviously do a lot of charting here today. One of my first visuals I always look at on a daily basis is a heat map on the market. As I'm looking at performance on a 1 day, a 1 week across the S&P 500, there are clear winners and clear losers. Now, this is a 1 day view. What stands out to you here, Noah, just visually?
That green, communications green, everything else is kind of a mixed bag.
And kick it back to a week. I mean, this is not just a 1 day move here. We're starting to see this over the last week. I mean, in last week, Google up 9%, Facebook up 13%, Apple 6%, Microsoft 6%, Berkshire down 6%, Wells Fargo down 8%. The banks are struggling, utilities are struggling, industrials struggling, the REITs are struggling. Let's get Mark's take on this. I mean, Mark, why do you think this is splitting this market over the last week or so?
It's the Robin Hood effect. It is the retail investor effect. It is people wake up and the world might go to hell in 3 months, but they want to make money today, right? And so they're going to gravitate towards brand names. They're going to gravitate towards what they know. And when people are making money on Netflix or Apple or Microsoft or Facebook or Chipotle or whatever these brand names are, these market darlings, that's where they're going to put their attention. Hey, finance can fall through a roof. Everything can fall through a roof. They want to make money. And so I think you have a Robin Hood retail investor effect piling into these names. And that's where they feel comfortable. That's where they're making money today. That's where they see the green on their screen. And so valuation, screw valuation. What does that matter? They want to make money today. And then what happens? Algos feed off of that. And then those names break out, those names go up, and everyone else. I think the rest of the market might be reflective of reality, and your brand names are reflective of sentiment on where people are piling on. And this is, I mean, once again, this is different than previous weeks. These names have been strong in previous weeks too, right? Mm-hmm. But everybody else kind of carried along, and there wasn't this huge separation. How long can these brand names carry the market? Well, that's a good discussion.
Well, in fact, if you kick it back to a 1 month performance here, Noah, you'll notice the whole market's just green over the course of the month. I mean, everything rallied there for a while, but then on the shorter, except for GE, which obviously
just wanted to point that out, Tim.
I mean, Noah, that's such a gift you're giving me right now. You know how much I enjoy watching that stock fall. But the reality is, I mean, the whole market was participating on the recovery with the Fed stimulus and all the money coming into the market and earnings season, expectations being depressed and all that kind of stuff. But now on the 1 day and the 1 week, we're starting to see a divide amongst the big names versus some of the weaker names. And I think it's really noteworthy. There's no question about it. Matt, what's your read on this whole situation? I mean, the market's splitting itself a little bit.
Well, it's something we've talked about over the last week about how, you know, in that initial recovery, you're absolutely right. The entire market's going to participate in the initial recovery. And then what happens is you start to see separation. And you're seeing that over the last week with you know, the semiconductor stocks to a certain extent, with Microsoft, with Apple, with Facebook, with Google, with Amazon, and what do we know? What do we know in common with a lot of those stocks? they have the ability to withstand a little bit of a deeper recession than say some of these other areas of the market. So you are starting to see separation with some of those blue chip names. And I also believe that, you know, the rule of thumb right now is blue chip and those stay-at-home stocks. I still think those are the two plays right now.
Mm-hmm. You know, and by the way, if you're out there watching our show right now, I always kind of get curious as to where everybody is. And I think it's good for us to understand where the community is coming from. In the chat, type in where you're watching the show. You know, are you in Texas, Utah, you know, across the world, over in Kuala Lumpur? Where are you at right now? It in the chat and let me know. Let's talk about the charts real quick here, guys. We're going to get through some economic data, some news as well. And then really the big stories today, I think, are earnings reports and whatnot. Noah, break that chart down for me if you can. Now, the S&P, and then we got to look at the NASDAQ and the small caps as well. But just give me a read on what you're seeing there, Noah, from a technical perspective.
Yeah, from a technical perspective, really today kind of makes me just watch that pause. And I'm really interested to see how the market reacts to some of the economic data coming out this week, plus the big jobs report on Friday's one I've got my eyes glued to. But the overall condition I see is a pretty good rally, but we do have slowing momentum. Now that slowing momentum would precede any kind of a reversal pattern. And if you were bearish, Timmy the Bear, and you're looking at this for the bear signal, you'd want to see it, you know, come in with a lower high and for it to drop down and break support. That would be a reversal signal. But in the meantime, it's still bullish. We're still making the higher high, higher low pattern. And if you're on the bullish side, what you want to see is you want to have it come back out and test and get through that 3,000 zone. They got a resistance zone, a 200 period moving average, and just the big fat 3,000 number. And it can do that. It just kind of depends on which part's leading the market. Now, tech's been leading the market. So you go look at the NASDAQ, you're going to see a slightly different picture, a little bit more strength. Then if you go look at the Russell, you know, that kind of lagged a little bit, or the Dow, you'll see they look a little bit more like the S&P. But I'm watching that. We're right smack dab in the middle of the last two pivot points. So whenever I'm in this situation, I'm looking at the chart and I'm just wondering which one of those is it going to hit first? Is it going to come up and hit resistance, or is it going to slow down and reverse and break that support zone? And today's little candle today doesn't really give me much insight to that. Just kind of boring today, quiet today. Might be a good day to go. Well, yesterday was Taco Tuesday, so I got to find something different to eat for lunch today. But when it gets this quiet, then I start wondering what's for lunch.
Yeah, it's a doji day on the market. I mean, for a lot of traders, I'm sure this is welcome, where the markets aren't always flying up or down 3 or 4 or 5% on a day-by-day basis. Obviously, the ES, though, is notably weaker than the NQ. Give me a peek at the NQ if you can, Noah. And this is that divide we were talking about, right? I mean, tech versus the rest of the market. The NQ is above all moving averages and has notable strength here today.
Yep, absolutely. Totally different story. And I can definitely say if you're a stock picking type of person right now, which I think this is the stock pickers market, you got to be bullish in tech. That's where the industry is, you know, really a lot of the big runs that I've seen that have really impressed me have come from that tech sector.
Mm-hmm. Guys, the jobs number came in today. We lost 20 million jobs in the month of April. Just dire economic data. There's no question about it. Every bull in the market could care less about the economics right now, Mark, because it's always priced in, right? But at what point does that argument also start to turn on the other side? Well, we already knew it was priced in. It was priced in. It was priced in. I mean, can we continue to ignore the economics behind the terrible drawdown in jobs, in consumer spending, and all this kind of stuff? I want to get Mark first, then Matt. Mark, what do you think?
Well, you got two minds, right, in your head. You have a trading mind and an investor mind. Like the investor mind, which Warren Buffett, he's not a trader, right? He's an investor. He's made his stance very known, as have a lot of other individuals, that the stock valuations are at insane levels. So if you are putting in your money from a market perspective in the face of all of the headwinds, that seems to be a very foolhardy decision in some very educated opinions, such as Warren Buffett, Carl Icahn, and many, many, many others who point to all of these problems. But then you have your short-term trading mind. And the short-term trading mind, if you don't let price action and your read of your gauges and your sentiment on these companies, if you don't let the short-term, I mean, the world can go to hell, right, in 3 months, but the trader has to let price be king in their trading decisions. And so it's your two mindsets, right? Will all of this matter eventually? Yes, it always does eventually. But the trading mindset
I
is
think so.
much different than the investing mindset.
I'm Timmy DeBear, but I mean, does it have to matter eventually? Matt, do you think that the fundamentals will eventually come to bear, or do we live in a market that is so manipulated by the Fed and QE type programs and government stimulus and forward PE ratios and algo driven to where we're just going to ignore this economic data?
Well, I think in the short term, it's not a form of analysis, it's a form of hope. People hope things get back to normal. People hope that this is a short-term bump in the economy. People hope that the jobs will come back. We shed 20.2 million jobs in the last month, and we hope all of those jobs are just going to come back. But what we're seeing out of a lot of companies and a lot of industries over the last week is they're still shedding jobs. Left and right. There's still Uber shed jobs today. Airlines are shedding more jobs. So, I think there's a hope that's driving this rally a little bit, that all of this is going to be a short-term bump in the economy, and the economy is going to be, just rip roaring because, we're reopening the economy, and because we're reopening the economy, everybody, corporations, consumers, institutions, banks, healthcare facilities, insurance companies, everybody's just going to go back to normal as this COVID-19 situation never was here in the first place. It truly does remind me a little bit of that initial drop in price during January, February of 2018 when we started the trade war. And then after that, the market just hoped this trade war was always going to be positive, and they never sold any negative news. But this economic situation is real to me. And I said this yesterday, from an investor perspective, I am focusing on the economic data because I do believe there's going to be a moment in time where the economic data does matter and that the fundamental valuations do matter. Yes, in the short term, anything can happen. Traders, algorithms, institutions, the retail investors, they can all, buy into the hope and, drive the market to irrational levels in the short term. There's no doubt about that. But we got data out of Europe today. The EU and the European Commission states that they're going to contract by 7.5% in 2020, which is the worst number since the Great Depression. Germany came out today and they had a record decrease in March factory orders. And these types of economic data points, they don't turn around overnight. So I think there's a hope that and I do believe some of this is driven politically as well, but I do believe there's a hope that because the economy is reopening up, that everything's going to go back to normal and the economy is just going to be rip roaring by the end of the year. And so we're going to discount anything short term with the hope that everything is already priced in, which, by the way, the priced in argument, there's not an argument in the market that I can't stand and despise more than the priced in argument. But in terms of that,
let me test you on that. I can test you on
sure.
it. Bring up the VIX if you can, Noah. Let's see if we can test Matt, if we can trigger him into a red here today. No, I won't even push you here, Matt. But the priced in thing, we hear it every day now. It's priced in, 20 million jobs priced in, unemployment. We're going to get a jobs number on Friday, priced in, all that kind of stuff.
But there's there is absolutely not one analysis. There's not one central bank president. There's not one, it's Treasury Secretary Mnuchin. Nobody can determine exactly where the economy is in 6 months from now. Nobody can do that. They can hope, but the economic data so far has not supported that thesis.
No, it has not even a little bit. It's a hope-based rally and a technical-driven rally, and we'll see how the fundamentals shake themselves out in the long term. That's why Buffett the other day said that he's staying in cash and it hasn't bought anything. Long-term thinkers, they're not jumping into this right now, but traders, Mark, people who want to make money today, they're jumping into the pool every day and buying the things that look attractive. And I think that's really where the market is, short-term versus long-term. Let's move through just some major stuff, and then we'll get into individual companies. Crude oil, first red candle in about 7. And, it did break out. I think we even touched that 25 level in that moving average. Look at that thing hit the moving average mark almost to a penny and then falter. What was your read on the EIA numbers today, Mark, and what's going on with crude?
Okay, the trend is nice, right? The inventory build of about 8 million. We're hitting clear. I mean, as far as inventory numbers, you got about as much inventory as you've ever had in the history of oil. So, but it's been declining lately. More and more analysts, Goldman came out and with a big, huge $50 prediction on oil. I mean, the oil sowing circle is
When, like next year?
Yeah, like next year, right?
Yeah. Okay.
And so the oil sowing circle is increasingly bullish on oil. There's still short-term issues. The biggest event in oil coming up is going to be, I think it's in 13 days, May 19th. I might be wrong on my date, on when that June contract ends, to see if there's any bid. Because remember, we had the minus $40 oil. That thing is the one thing that people are hesitant on oil right now.
Mm-hmm.
But the oil, there is more bullish chatter on oil right now than I have seen in, since COVID-19 first.
Click on the trade tab here, Noah, and let's look at those actual contracts, because I do think it is 13 days. And the CL contract, you'll notice that June contract expires, what is 13 days from today? May 19th, probably, I guess, is what it is. But the options expire before that mark. There's that little window in between when options for the June expire to when last month we went negative. Do you still think oil is going to stay stable through that period? I mean, this is kind of, it's amazing theater, in my opinion. How you trade it, I don't know, but.
No, it's the storage issue, which caused the May sell-off. I mean, there's reports that all of the bid and Cushing has been taken out, which the storage is still a huge, massive, gigantic issue that could cause something really massive to happen in oil when those June contracts come out.
Mm-hmm.
If it doesn't, the production cuts that are underway, the rig counts that are falling, if it doesn't go negative, I think there'll be a huge rally in oil. So, it's one of those things. If it doesn't go negative, if it doesn't fall through the roof, traders, the oil sowing circle, oil investors are going to be like, oh, storage issue solved. Really significant rally happen after, if there doesn't appear to be that negative bid, that huge sell-off. But that's a lot of ifs, right? That's a lot of ifs. But the sentiment is definitely turning more bullish across the board on oil analysts.
I'll be very blunt. I'll make a statement. You guys tell me if you agree with it. I'm a stay away on oil until I get clarity, more clarity than what I have right now. I can just trade it later. I can just do something later on it when I have a more clear chart. You want to just take the technicals, Matt, maybe a higher pivot low, a little breakout of the moving average, whatever it is, get through the June supply thing, get through some of this reopening phase. I'm not having any FOMO about missing out here, but maybe that's just me. This little next stretch in oil, we just had 7 huge rally days. We got a red candle here. I mean, I just don't know, guys. I don't have a feel for this, obviously. And I think the short term is very unpredictable. You can easily map out better plans long term. I mean, Matt, what do you think on oil here?
Well, in terms of that, we talked about this a little bit yesterday where, that breakout of 20 was legit. It obviously drove momentum all the way up to about 25. But that 50-day moving average was, staring at smack dab in the face, and it was going to play a role. And when you're overextended in the short term like that, you're probably going to have a little bit of profit taking. You're probably going to see a little bit of a downward movement in price. But oil is only down 5% on the day. And, when you're talking about oil over the course of the last, 14 days, that's actually a reduction in volatility. So you do, yeah, it is crazy. But you also have the 90 EMA crossing above the 20 period moving average. And I think you have that significant whole number at $20 that if you do get some type of, doji-based reversal signal, that you could map out some short-term trades going back up into $25, $26, $27. So in terms of the overextended, yeah, I wouldn't be a buyer at these levels, especially after it's overextended. But give me a little bit of retracement, come to kiss off the 9, kiss off $20. You could definitely map out a short-term trade. Now, obviously, with oil, it's going to be very sensitive to news. It's going to be very sensitive to that June contract. So could you stay away? And could that be a legitimate decision? Absolutely, 100%. There's other areas of the marketplace that are easier to find trades and good technical setups than in the oil market. So from a directional perspective, the way Mark approaches it is from a cash flow perspective. Neutrality and upward movements in price and even downward movements in price don't nearly weigh on a theta-based trade that it does on a delta-based trade. So I just feel like if you're not willing to take on the risk of the volatility and the uncertainty in the news cycle in the oil market, there's a lot of other areas of the market that are just simply a lot that investors and traders have more confidence in. We talked about the blue chips and money running into the blue chips. Look at Microsoft's chart today. If you're looking at Microsoft's chart today, you're saying, okay, yeah, I can map out a trade on Microsoft far before I can map out a trade on crude light right now. You can say the same thing on a lot of these high flyers here today.
Mm-hmm. Mm-hmm. With crude, I don't know. I mean, there are signs of stabilization in the fundamentals and the technicals and the sentiment, obviously. And we've been talking about the little W pattern breakout and whatnot. I mean, Mark, it's going to be fascinating theater, regardless of whether you play it or not, one way or the other, how you trade it or whether you stay away from it. The next 14 days in oil are still going to be very, very fascinating to me. Don't you think?
No, after those, like seriously, like after those June contracts expire, you could have an amazing trade on oil coming up, a nice position trade. I mean, it is going to provide so much clarity on that, and I'm really, 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 really excited. And now, Tim, should I sell another naked put on USO? I'll let you decide.
You probably make money, but that probably just talked you out of it. So
yeah, I'm
doing some Jedi mind tricks on you right now. And Mark is so stubborn. Mark, you do what makes you feel good, brother. I mean, I'm open to it. I understand you got a system, you got an approach to it. I have other preferences in the market. I would rather buy some of the big tech, like the market is running on this FOMO, than try to spec on oil right now in the face of some of this complexity.
Well, I just sold another 12.50 expire next week. Give me $12, which I can go then buy a Wendy's meal that doesn't include hamburgers.
Chicken sandwich. The spicy chicken sandwich is the best thing at Wendy's. Gold down a little bit here today, but holding support. There's not much in the chart. A little wedge up here, guys, but I don't really care one way or the other, quite frankly.
It's a support, like the thing about gold, like like that support level that has been formed over the last 3-4 weeks. That's a nice little technical level, right?
Mm-hmm.
That's a nice little technical level. Like short-term price movement on gold, will that support level hold?
Mm-hmm.
If it does hold, I might go buy some, but I'm definitely, once again, would love a sell-off. Gold's amazing. Gold is thing. It's just, how do you want to play it? One day, a naked put I sell on gold will not expire worthless.
I know you're hoping for that. It's the funny thing about
one day.
Yeah, GLD is obviously a very, very popular way to approach the gold markets. And Mark, like you've been using naked puts down in the 140s, I believe. Is that right?
Yes.
Yeah. I mean, if you had to buy gold at the 200-day moving average, I don't think anybody's going to have a hard time with that. So I get it. Up here holding support. The dollar, man, I had a question in the chat. I'm trying to find it. It was directed right at you. Give me /6J if we can. I think this is the Japanese yen. Cody, Cody, did you see it? I think it was.
Yes, it was from Adam.
Yeah.
Yeah, Adam's question was, can we talk about the Japanese yen moving up as a safe haven currency? And when you're looking at those safe haven currencies, you really have three of them. You have one for the Asian zone, that's the Japanese yen. You have one for the European zone, that's the Swiss franc, and then you have one for the Western Hemisphere, and that's obviously the United States dollar. I think what you're seeing here is, especially in the yen, and kind of starting to see it in the dollar as well, is you're seeing money flow into these two currencies, given the fact that a lot of the economic data that we have been seeing and a lot of the projections we have been seeing out of the central banks and the European commissions and so on and so forth have been really, really dire for the Eurozone. We haven't seen that degree of negative economic data come out of Japan yet. And quite frankly, America was kind of lagging the Eurozone from a COVID-19 situation. So even though we've started to see that negative data come into the U.S. zone, in Europe, it's just devastating, just absolutely fundamentally devastating economic data coming out of the Eurozone. So I think what you're seeing here is you're seeing money flow out of the euro, and it's coming into some of these other safe haven currencies. We're talking about the three largest currencies in the world when you're talking about the US dollar, the euro, and the Japanese yen. The breakout on the yen is absolutely tradable. And when you're looking at the yen, you can look at the yen against the dollar, and you can look at the yen against the euro. So let's first take a look at the yen against the dollar. Give me USD/JPY, please. When you're looking at this, you're seeing a little bit of a bearish breakdown on the dollar against the yen, down pretty healthy on the day as well, and a close underneath 106 could be momentum traded under these levels as well. But when I'm looking at this, I'm looking at that euro Japanese cross pair. If you can give me the euro/JPY here. And I'm just seeing just a bearish breakdown of just epic proportions here. I mean, the last 3 days of data we've seen out of the Eurozone is truly devastating economic data. And when you're looking at, perhaps, momentum trading in the currency market, I would be looking at some of those cross pairs against the euro right here. And when I'm looking at if you'll take a quick peek at the euro versus the US dollar, that chart's a little complex right now. It's a little scatterbrained right now. I mean, it's hard to find a trigger that you feel comfortable with, because you got these long wicks, long tails. You had the initial sell off. It's really tough. But when you're looking again at the euro versus the Japanese yen, you got a little bit of clear selling here.
Carry rates, I think, are obviously going to be fascinating to me as they watch this thing unfold. But just to move out of the euro into some of these other
Carry
safer
rates?
Yeah, there's nothing there.
Everybody gets zero.
There's nothing in the
I was going to say,
bond.
what carry rate?
What carry?
So where do you go if you're the investor that wants yield, not asset appreciation? Because traditionally bonds,
Not to currencies right
not
now.
in the currency market.
Yeah, not to currencies.
it's
now this is what I've been doing. I mean, I've been starting to become interested in a couple of these midstream natural gas companies. WNB, pull up WNB.
so dividends is what you're going to say.
And once again, this is a lot trickier market than it's ever been in for the dividend type investor. Like the dividend type investor, like how many companies have slashed dividends, right? How many companies that didn't slash dividends are a little bit worried that those dividends would be cut? Like the dividend investing right now is a lot more difficult than it's ever been maybe in the history of dividends, right? It's just unprecedented what is going on. And so finding companies, if the cash flow is your primary king, and I'm very dividend light in my portfolio, finding companies that might or look like they have a stabilized business structure where that dividend is safe, it's difficult to find right now. Williams Company is one of those companies that I'm trying to target, selling naked puts at lower levels. Feel very comfortable. Look how the price appreciation, how quickly and consistently it flew up after the bottom lows. Williams Company for me is one of those companies that I like, especially at lower levels, building a dividend position. So hopefully
one of the things that has stood out to me in this market rally we've seen over the last 6 weeks, though, is it's not the dividend payers that are outperforming. It's not the dividend payers. The dividend paying companies have significantly underperformed the market rally.
Yeah.
And full disclosure,
But
I have
why?
a naked put.
Why?
Why have dividend payers underperformed? It's because all of the trading money is going into Wayfair and Chewy's and Microsoft and Chipotle.
Well, that's not smart money, though. The smart money is staying on the sideline waiting for those dividends to get actually a much healthier number, and that takes some time.
So
look at DVY if we can, while we're talking about this, one of the ETFs on the dividends. Could it be because of the energy weakness and so many companies that offer good dividends or energy?
What about the REIT weakness? What about the utility weakness?
What about the bank weakness? I mean, a lot of your traditional dividend players are in the line of fire, right? Of all of this, banks, oil companies. I mean, so that dividend yield. I mean, JP Morgan, Jamie Dimon even said in his conference, like, hey, listen, we're willing to cut our dividend if we have to. But dividends in a lot of the traditional players are not safe like you would traditionally think. And so that yield, because so many investors are nice, boring dividend investors, right? They want to build up a cash flow position. They want to have that nice steady dividend, and their world's been rocked over the last 2 months. Totally rocked. Not in a good way.
I think that's very telling, though, that you have a lot of these companies that are talking about perhaps, slashing dividend in the face of some of these economic realities. But then we hear from a political perspective, a central bank perspective, and a retail side about how everything's just going to recover in a V-shaped recovery. But when you're talking about a lot of these energy companies, a lot of these bank companies, Disney cut its entire first half dividend payout, which was $1.6 billion. I think that's very telling of what these companies are saying about the true nature of the uncertainty of the economy in the future.
I do as well. So in the face of a recession, the worst economic data we've seen in the history of the market, probably in the short period of time, you're seeing dividends underperform and high PE ratio, debt-driven companies outperform. Interesting. But Mark, you got to be a part of the team, right? I mean,
but that does not sustain a long-term rally, Tim.
There's
only
you don't get a long-term sustained rally in the market, a long-term bullish thesis in the market until the value investors come back into the market looking at attractive valuations and attractive dividends. And right now there is not an attractive dividend in the market to offset the risk, and there's not an attractive valuation to offset the risk with the high valuations.
Now the counter argument to that, which I don't necessarily agree in, is Apple and Microsoft and the Microsoft darlings have no limit to what they could go up in the short term, right? I mean, you look at Apple's chart. I mean, every breakout, every technical signal is just being bought up. Yeah. They do not care about your valuation argument, individuals buying Apple. They don't care about the future argument. They're like, I'm making money today. I really believe it is that simple on the Robinhood effect. I'm making money, and so I'm going to chase momentum. I'm going to chase money.
Apple also has what, $250 billion in cash reserves to handle anything about this. So the argument on when you bring up Microsoft and Apple, you're talking about two blue chip stocks that are, have been the darlings of the market, not in the last 6 weeks, but the darlings of the market in the last 12 years. And there's been no word that Microsoft or Apple's looking to cut dividend, given the fact that they have the cash on hand to handle anything that might take 6 to 12 to 18 months from an economic situation to really pan out.
A couple questions in the chat. I actually like them. Then we're going to talk stocks, Disney, all of these other ones you guys have been referencing. We're going to go through the earnings roundup. Noah, give me a quick Elliott Wave read. AS, who's a new person on our channel. Welcome, AS. Do you think the SPY will go down due to the Elliott Wave pattern? Noah, if there was ever a softball question for you, it is this one right here. You're on mute. Come on off.
There you go. Good old Elliott Wave. I'm a fan of the Elliott Wave, and this is the last stand for the Elliott Wave theory at this price level. So I'm looking at the S&P futures, not the SPY, because it gives you a cleaner chart. And if you want to sit and do your wave counts, you are up 1, 2, 3, 4, 5. You're coming off of a fifth wave, but you're in the context. Let me grab my good old drawing tool here. You have to consider the whole context. This is your down 1, up 2, you got a down 3, up 4, down 5 in there. So you actually have a 5 wave count down, and you have a 5 wave count up. And in Elliott Wave theory, the correction cannot cross back into wave 1, and or it's about the 61.8% retracement. So that's where the market is at the moment. It actually pressured that level. So if you go do a classic Fibonacci retracement and you draw that, it'll show 38.2 here because I drew it backwards to just show the forecast. But that's the level right there at the 29.20 ballpark. Let me draw it from left to right so it shows the 618. But it's the same price level. So 29.26, and it came up and it pressured it. And it's ended up, poking its head up one day, closing back down the next. Then it tested that wave 1. We'd have to see a breakdown from here in order for the bearish Elliott Wave theory to have any weight to it. whatsoever. And normally in the downward correction, you don't see a 3-wave move up. You see the drop down. You don't see a 3-legged move up. You see a 2-legged move up and then the drop. In this case, a 3-legged move up tends to lend itself a little bit more to the bulls. So, but I keep wondering when reality of the economics will catch up with the market. Because this is one of those where, my Timmy the Bear comes out and I can see the pattern. I can see the formation. We even mentioned it earlier. I could see where a head and shoulders pattern or an M for murder pattern forms there. And you do see that give us another leg down. And then, I think after another leg down, you probably get more of the investor class, looking for the dividend payers and the value investors to come in.
Mm-hmm.
But in the meantime, I've been studying a lot of MMT, trying to wrap my head around it. And I keep wondering if they print enough, if they stimulate enough, if they'll overpower all of those classic wave patterns.
Those are the big questions. The Fed put, right? The Pal put and all that kind of stuff. Thank you. No, appreciate it. Let's talk companies here. Disney first. We've been watching this one. We've been talking about this one. There's been a lot of
question though before we get into earnings.
Sure.
So if we see another leg down in the market, and economically, I do believe that supports that thesis. What's the Fed put going to do? Are they going to pump another $2.5 trillion? And is the government going to borrow another $3 trillion just simply because we're retesting the lows?
6.
I bet they would, man.
Well,
I mean,
we'll have a lot of fun paying 200% food prices.
I mean, they've shown
but as long as the stock market goes back up into some mean of average price action, that's fine if the consumer base can't put food on the table.
Dude.
Well, at this point, up to now, we haven't really seen inflation keep up with the printing. That's the argument of the modern monetary theorists, is they've increased the monetary supply, but the money's going into asset classes. It's going into the market. It's going into real estate, but it hasn't hit the consumer pricing index as hard as one would expect.
Well,
I think that's why they keep doing
a very lagging indicator, though.
Well, it is a
takes
lagging
time for
indicator.
producers to extend into the consumers.
Yes, and then they keep massaging the metrics so that they don't register as hard, like they remove things from the equation. But it hasn't. That's the argument that the MMT guys make, is that it has not affected the consumer price index, but it does price people out of a home. It does price people. I mean, the stock market's gonna soar because if they keep printing with the velocity of money, you got to put it somewhere. Otherwise, you'll see stagnation. So that's the big question: is does MMT? It'll work until it doesn't, is kind of my take. But I think it could work.
When it doesn't, it's pretty scary, by the way.
That's the problem.
When it doesn't, and MMT is not I know we call it modern monetary theory, but MMT policies have been played out in the future regarding currency. And when you're talking about these MMT policies and you're talking about, oh, we don't have any inflation, we can print until we don't. And I don't want to go doomsday here, but at that point, you're not just talking about the massive rise of inflation to offset the massive rise in debt, which a lot of countries around the world in the last 100 years have done modern monetary theory just to offset their debt valuations by rising the levels of inflation to offset debt. Two famous examples of that were Brazil in the 1990s and the Weimar Republic out of Germany in the 1920s. And both of those currencies died, along with many, many, many other currencies that have tried to do this in the past. So I get it. The modern monetary theory, it's a theory of hubris. It's a theory that lacks historical perspective, and it's a theory that they're applying in the short term, risking the long term. And maybe I'm just an old-fashioned conservative, but I just do not believe we should ever put the short term in front of the long term. And quite frankly, I am sick and tired of everybody in this market doing that. I'm sick and tired of the central bank doing it. I'm sick and tired of the government doing it. And I'm sick and tired of consumers putting short term in front of long term. That's why
they're all going to keep doing it, right? Whether they should or shouldn't.
Who's all?
The Fed will.
The federal government, Nancy Pelosi.
Well, are we calling
Mitch
again?
McConnell.
If we get another leg, Mitch McConnell's not calling for more money coming into the market.
Well, they've all been very liberal with the amount of money they are willing to spend. Right.
If you have a second wave in the fall and you have another leg down and the economy does not recover like the hope that the consumer base and the government and the central bank wants it to, because I don't believe the corporations are telling us that this is going to be a V-shaped recovery. I think it's the government, I think it's the central bank, and I think it's consumers who are saying this is going to be a V-shaped recovery. Most corporations have warned on guidance. Most corporations have removed their entire guidance. Most corporations are looking at this and saying this could be something that could take a long time to pan out. So I don't think it's the smart money that is saying this. I don't think it's the corporate money that is saying this. And so if we get another leg down, and if we don't see the V-shaped recovery like the hope that people want it to be, are we really saying the Fed's going to pump another 2.5 and the government's going to pump another $3 trillion into the financial systems?
I don't
Is
know
that
if the
what
government necessarily will, but the Fed will. The Fed has already said that themselves, basically. They said they've got a bigger bazooka. I mean, how many times we heard that in the last 6 weeks? I mean, Powell last week in the statement said, we will do any measure necessary. It's scary to think about the economic fallout from if it doesn't work, though, by the way. If you have another leg down and the money coming in doesn't
let's
actually
remove the if for a second. It works in the short term. It is not one time in human history has the policies of modern monetary theory played out in the long term. Not once. There's not one example.
But what happens if it's not for 30 years, right? What am I supposed to do between now and when this eventually happens?
Most of these cases, Mark, don't take 30 years. They take 3 to 5.
You know, like, I mean, but you know who doesn't worry about that today? The guy who bought 100 shares of Microsoft's up $300, or bought 100 shares of Nvidia yesterday and is up $600 today. Like,
that's fine. Enjoy the short term, but there is going to come to Jesus moment for all these short term momentum in not just traders. Traders are going to get in and out, but these people who are chasing the fairy dust and dreams about how they're reestablishing all of this, their portfolio for the next 10 years, and there's never going to be another downturn in the market because the Fed's just going to always prop up the market. I'm sorry, I just don't buy that from an economic reality or evaluation. And again, call me the old-fashioned conservative, but I don't believe the Fed can continually pump in that much money into the system just to support a market that is stabilizing.
All right. So, but what am I supposed to do to make money? Because that's what I wake up and I worry about. I am the youngest person on this panel by action, even though I'm the oldest person by age, because all I care about is making money. Right. So how am I? Because I agree with you. Listen, I agree with the general premise that something really, really bad is going to happen with the dollar one day. Something really, really bad is going to happen with all of the things you just said, which is why I'm more in gold today than I've ever been before. So I agree with the general long-term premise, but I don't know when that will happen. It could happen 30 years from now. It could happen 10 years from now. It could happen 15 years from now. It could happen 3 years from now. But it is some point in the future. What am I supposed to do between now and that point? You know?
Well, my advice is I think you should worry more about your retirement in 12 years from now than you do about making money today.
Well, the two kind of go hand in hand, don't they?
No, absolutely not. When you're talking about long-term investing versus short-term trading, even you have said they're completely different.
But at what point then do you think you should come into stocks? I mean, there has to be some plan of making money.
So which Austrian economist does Matt look the most like? I'm just trying to figure where we should throw him in that picture there.
Well, they're all rolling over in their graves.
They're all
right
definitely
now.
rolling over.
They're definitely not happy.
I like the guy, the guy with the big beard. Like, so you got the guy on the far left with the black hair, but the guy right up, yeah, him. I think that's Matt.
That's old man Matt. I like it.
Take that. I can take that.
Mark, you make money the same way you've always made money. There's trading opportunities and they're different from investing opportunities. And you have to separate the two. There's no question about it. There's a reason why we talk about Warren Buffett different than we talk about day trading signals, right? I mean, the short-term trading opportunities have been there. They'll always be there in any market. Volatility plays, earnings plays, day trades, things like that. Position sizing, target, entry, stop, all of those things that go into planning a trade, like we teach in the STEP system, you can apply to intraday charts right now. You can do naked puts like you've been doing recently. But I think that the main difference between this conversation is let's not apply that to long-term assets, because there still is difference in the way you got to approach those things.
Yeah, I mean, everything our conversations in the last month have been dominated about short-term trading.
Mm-hmm.
We really haven't even talked about long-term investing. And so in terms of the short-term trading, like we've been talking about for 6 weeks, you have the stay-at-home stocks and you have the blue chips, safe haven type plays of the Apples and the big tech and so on and so forth. So yeah, you ride that momentum in the short term. I'm not saying don't do that in any capacity, but I do believe there is a seismic percentage of the population in the U.S. that is treating this market from a trading perspective and utilizing it as a way to get into perhaps some types of long-term investments. But I just don't think we should forget the lessons of Warren Buffett simply because we have 6 weeks of momentum trading.
Yeah. Trade for profit, short term, invest for wealth, long term. I mean, there's a difference in philosophy. Good questions, good conversation. And I do think there is we have to keep talking about the fundamentals. Matt, it's good to have you back. I need somebody on Timmy DeBear's team. Everybody's been on this momentum team. And, obviously, Matt, you have a difference.
I'm not a bear and I'm not a bull. I'm both. I will always take into account the fundamental valuations from an investing perspective. I will always take into account the economic conditions from a data perspective and not an opinion perspective. And so, like I said, as a trader, you're a bull, you're a bear. They're the biggest flip-floppers in the world. They'll go from bearish one day to bullish the next. But from an investor perspective, I think people should be very cautious in this marketplace.
Mm-hmm. Let's talk stocks. Got a lot we got to go through and unwrap. Disney next. Let's go through our earnings roundup. Very interesting, very important company, Dow Component. Obviously, one of the most recognizable brands in the world. Mark, what did you get from Disney's earnings report?
This is going to totally set Matt off. The earnings report was priced in to the market. But I've been saying this all week, right? I've been like, what are they going to say on their earnings report that people don't already know? It's terrible. Guess what? Matt will share more data on it. It was terrible.
How is it priced in? When the expectation is 83 cents on EPS numbers and it comes in at 60 cents, how can anybody make an argument that a massive miss on that was priced in? Wouldn't the analyst short-term price action is foolish in my opinion. But in terms of it being priced in, again, the analysts who covered this stock come out and put out an expectation a week in front of the earnings report, and they came in with an average expectation that Disney was going to come in at 83 cents per share. They came in at 60 cents per share. So simply because the price didn't do something today, it's priced in. I just don't buy that argument. But Mark, you are absolutely correct. The report was really, really devastating. It was something that we talked about yesterday. We did expect. We talked about Disney. The concern in Disney was going to be the parks, the movies, the ad revenues from the loss of revenue from ESPN and other business ventures they have on live television, sports, and so on and so forth. They came in at 60 cents EPS versus 83 cents on the expectation. Revenue actually did come in pretty close to what the expectation was, 18 versus $18 billion. The cutting of the dividend of $1.6 billion in the first half of 2020, obviously very concerning. And the removal of guidance, which we've seen as a common trend in this over the last 6 weeks of these companies constantly removing guidance, because once again, the uncertainty of where the economy is by the end of this year. But on a positive note for Disney, they did hit 54 million subscribers on Disney Plus, which was above the analyst expectations. And I think they weren't expecting I think that it was by like the end of 2021 or something like that. Maybe I'm getting that off. But by the end of 2021, they were expecting about 60 million subscribers on Disney Plus. So there are like we've seen with a lot of these, Netflixes of the world adding a lot of short-term subscribers. Disney is also adding a lot of short-term subscribers. And obviously their US parks are remaining closed, but they did announce their Shanghai Disney park is opening up. So the overall report was really, really bad. We expected it to be bad, but it was a little worse than the expectation.
By the
Yeah,
way,
but this is the trend we've seen all earnings season. When individuals know that it's going to be terrible, you see almost zero price action following earnings.
mhm.
I mean, it was like, it's actually been amazing. You might not ever see anything like this ever again. But it's like the worst it is, the less price action there is. And I don't know if that is a level of manipulation. I don't know if it's because people just expected it to be bad, but it is a trend we've seen all earnings season.
Yeah. Them pulling the dividend makes me like Disney even more, by the way. When corporations cut hundreds of thousands of jobs in the face of a recession, but then continue to pay dividends to their shareholders, I have an ethical problem with that. So I actually think Disney pulling the dividend during this time was the right thing to do.
I don't know how they wouldn't. They bled a lot of cash in the
Sorry,
last quarter.
I stepped away from my computer for a second. Is that Tim or Bernie Sanders speaking right now?
Listen, you can't fire the
Listen,
princesses.
You
at
can't
Disneyland.
fire. Come on, do your best impersonation. Come on, Tim.
I don't know if I have a Bernie
Well,
impression.
I don't think it's necessarily a left talking point any longer about a lot of how these corporations have been supporting the investor class while leaving the consumer class by the wayside. I think that's a center right, a center left, a left, and a right principle. I think if you took a poll of the average American in the United States, most people would be very, very anti-corporation right now.
Yeah. I think it just all comes back with Disney, obviously over time is when do people go back and go back to theaters, go back to the theme parks and all that kind of stuff. And the frank answer is we just don't know yet. Earnings report was awful. The market doesn't seem to care in the short term here. Let's talk.
Like the bull should worry the first time awful data comes out and it actually sells off, right?
Or good data. Let's say good, even the worse, I think, Mark, good data comes out and it wasn't good enough and the market starts reacting differently on that side of it.
The data does not matter at all right now. It just doesn't. At one point it will, right?
Mhm.
That's when bulls should probably be scared.
Activision next. Let's keep moving through some companies. This is one of our favorites, obviously. We talk about it. It's on some of our core watch list. We keep track of it. Gaming, the stay-at-home play, the coronavirus watch list, which has been on our stock report for a long time. Activision was right there. Matt, what do you see in their numbers here?
You know, Tackle 25 stock Activision, obviously one of those stay-at-home stocks. Expectation, I mean, just a rock star report, to be honest with you. The antithesis of what we saw out of Disney today. But again, that should show you everything you need to know about this marketplace, where you have stocks like Activision, EA, both do absolutely amazing on their earnings numbers, and the companies that are in the front line and center in the battle against Corona and COVID-19, just getting, really underperforming in the marketplace. Activision came in at 54 cents EPS numbers versus the expectation of 33. Revenue had a very, very good beat in 1.8 billion versus the expectation of 1.3 billion. I do believe I have supported some of that revenue coming into Activision over the last 6 weeks. But unlike a lot of companies who are either reaffirming guidance or many, many, many companies, removing guidance, here's Activision. Hold my beer. Watch this. They upgraded their guidance fairly healthy over the course of the next 6 months. Obviously, a nice little breakout here. Tough to chase it. I mean, when you're looking at breakout candidates from a technical perspective, the response to the cash open, to me, is as important as the response on the overnight action as well. And you did see a little bit of selling here, so I wouldn't be chasing here. But you give me a nice little retracement on Activision. Oh yeah, we could sign up for that for a swing trade. You're mute, T.
And it definitely keeps it on our watch list firmly. There's no question about that. Pretty rock star report. And the fact that they upped their guidance is really impressive. Not many companies.
Oh, they didn't just
are even
up it, Tim. They upped it a very healthy amount.
Yeah, that's really good. EA, you mentioned as well. Real quick look at that one if we can. Obviously, the gaming sector, they didn't react from a price action standpoint as well, but they also had pretty good numbers, Matt, don't you think?
Very similar numbers to what Activision came in. I mean, it's similar companies too, right? But when I remember breaking down the Tackle 25, looking at Activision versus EA, and we were going to add one of them, and I really couldn't find a discernible difference between the fundamental nature between Activision versus EA. And quite frankly, on the earnings numbers, a very similar type situation, $1.43 on EPS numbers versus the 97 cents on the expectation. Came in with a healthy beat on revenue numbers as well, 1.4 billion versus 1.2 billion in expectation. And very similar to what Activision did, they also upgraded their guidance here. And when we see a company beat on EPS numbers, revenue numbers, and upgrade on their guidance, we call that a triple whammy. And that's something that people should have on the watch list. Now, obviously, you would have loved a little better response from a technical perspective, but I'm not taking that as a negative at this point. You're still looking at a bullish uptrend, and you're still looking at a little bit of short-term consolidation.
Yeah. So market darlings, Mark, I'm going to bring you in on analysis on these ones. Shopify first. Obviously, we've been talking about some of these stocks that are momentum plays, and Shopify comes literally at the first and forefront of my mind. Mark, obviously a beautiful upward trend, and bulls have been very, very well rewarded from holding on to Shopify. What did you see in their earnings report?
I mean, when you have growth companies, it all becomes a question of valuation. But from a technical perspective, you had a beautiful breakout heading into earnings on a market darling. Make no mistake, Shopify is one of the most beloved companies in the market. 47% revenue growth year over year. Strong growth, strong trends, but it's suspended to 2020 guidance.
Mm-hmm.
And that's a big deal for me moving forward. So like AMD lowered their guidance a little bit, right? Microsoft held their guidance. When a company suspends their guidance, chase it momentum style. That's very, very concerning to me, but market doesn't care. Listen, the market darlings, it doesn't matter. Data does not matter for these market darlings this week at all. It doesn't matter. Do they love them? The market participants are seeing what they want to see. But the suspending of guidance of Shopify takes it off for me from a preferred pullback play list. Still trade it technically. Shopify is an amazing company technically. Like patterns on Shopify, like breakouts when they occur, moving average signals. I mean, you go look back at Shopify when it broke out of some short-term resistance in November, December, just a nice steady trend. When it broke out of the resistance points in March, nice upward movement. This is a monster when it comes to technical patterns, Shopify. Like very few companies from a technical perspective that I like trading more than Shopify. But from that value investing, that growth investing, whatever the thing, the pulling of guidance, well, trade this thing to the moon comes home because it just people love it. But
well, the number that stood out to me, Mark, in Shopify, and I'm also concerned about removing guidance, but Shopify is one of those companies that it would be very, very difficult to determine where their revenues are in 6 months from now. It just will. So I don't blame them for that. You never want to see it, but I also don't blame them the same way I don't blame Disney for removing their guidance, just given the fact that how in the world do we know how people are going to be, behave, the consumer behaviors from a consumer perspective at those Disneyland parks and movies and so on and so forth. And when live television from a sporting perspective comes in. So I do understand it, even though it's never looked upon as a good thing. But when you're talking about the difference between growth versus value, valuations, P ratios, PEG ratios, debt to equity ratios, book value, everything that we look at from a value perspective is not necessarily as important from a growth perspective. When you're looking at it from a growth perspective, which Shopify is definitely one of those market darlings, growth type companies, that plus 40% year over year revenue is what you want to see from a growth company.
Mm-hmm.
Yeah, and from a trading standpoint, put Shopify on your trading watch list. It should be, if you have 10 companies and the only 10 companies you're ever going to trade, not talking investing, talking trading, Shopify has for years been a technical juggernaut when quality trading signals are produced. Very followed by day traders, very followed by swing traders, and the price movement you can get on technical signals, boy, it is just one of those really beautiful stocks. I mean, you're just seeing it with the breakout over the last couple of days.
Mm-hmm.
So learn how, and this is a great time. If you don't know what I'm talking about when I'm talking about technical analysis, go sign up for a 15-day free trial at tackletrading.com. Go to the store page, sign up for the trial, email me at team@tackletrading. Like literally, you might only make 4 trades on Shopify a year, but go back on the charts and see how profitable those trades can be applying technical analysis. Like if you only have a 10 stock watch list, Shopify should be on that 10 stocks. It's an amazing company.
Shopify was on our scouting reports in 2019, probably more than any other stock. It is
clean.
It is a stock that can run. And you know, I sometimes I get a little hesitant when we have, you know, things go from 350 to 733 in, you know, in the short term. But go look at that 2019 very consistent trend line. It's been one of those companies that is, you know, whenever it gets around that 200-day moving average, the investor class comes in and just buys it up at the 200-day moving average. Traders are going to short-term momentum. One reason or another, and we can get into that sometime in the future, but the market has loved this stock for a very long time.
Mm-hmm.
No, and if you're the type of individual out there that's just like, well, I'm going to go buy Shopify right now, go watch some other live program on YouTube. We teach people to be market assassins. We teach people how to read charts and look for high probability signals. Blindly buying, well, listen, just go away. Like, because we don't want to be part of your failure. But if you want to learn to become great at trading, truly great, a market assassin, learn technical analysis, will teach you the skills, and then you can take advantage of these situations that you see in Shopify or Microsoft.
You know,
or anything else.
speaking of technical situations, Noah, if you'll, you know, give me a 30-minute chart on Shopify, kind of what I said on when we were looking at Activision, when you're looking at the earnings and how Wall Street is seeing the earnings numbers, it's not just on the overnight action that's important. When you're actually looking at the overnight action was not very good for Shopify. It actually came down fairly healthy on their action when they actually posted their numbers. But when that came out with that cash open, the traders came in and they bought it up. And you saw initially in that first hour of the trading day, a tremendous amount of bullish momentum with volume to support that type of movement. And now what you're starting to see from a technical perspective, and if you're going to, we talk about momentum playing quite a bit in this market, and from a momentum perspective, you know, looking at this from an intraday perspective, you got to play it bar by bar, you know, and if you're looking to play it, you find your intraday resistance level that you're willing to get it above, whether that's 730 or 733, which was the high. You get a stop loss. You get a stop loss right underneath, say, you know, 215, which is the intraday support level. And you take on the $15 of risk for a potential, you know, momentum play. That's how you play those types of momentum plays, because you certainly can't get a stop loss underneath the cash open. You got to find that intraday level that you're comfortable with.
Bar by bar, and multiple time frame analysis is very, very important part of TA. Love it there, guys. Let's move through some more companies here. Let's talk about Match.com next, if we can. Just a continuation off of the data there. We did mention it a little bit yesterday, but look at that momentum play here, guys. I mean, that's a breakout, isn't it, Mark?
Listen, Match.com came out with their earnings. They said they're having more conversations, COVID-19, and the conversations are longer. So basically what they're telling you is, instead of saying, hey, you're hot, let's meet up, people are actually talking and getting to know each other on the dating apps.
Isn't that a good thing?
They're seeing tremendous resilience amongst the 30 and under crowd. Now, Match.com owns a lot of online dating properties. Now, I have long been a fan of Match.com, the secular trends, plus COVID-19, let's be honest. You're going to see divorces skyrocket over the next 6 months because people are like, I can't believe I'm married to you and I can't take this anymore. So they got
so people want the economy to open up slowly so we don't have to be with our family.
Well, listen, let's just say,
I do think there's some of that. I do.
No, I'm not even joking. You're going to see divorces kick up, but you're seeing online dating first. Plus, when you look at this, and this is from an investing, and my Match.com thesis is very, very simple. They got some competition from Facebook, but they own a lot of different properties, right? A lot of different dating properties. And what I loved about the earnings report was there is was tremendous resilience in the 30 and under crowd. And so and I'm talking about from an investing standpoint, like they own Hinge and they own Tinder and they own Match itself and they own some other, I think they might even own Plenty of Fish. But they own a variety of things. Online dating becoming more socially acceptable, and the resilience that the earnings report showed in that 30 and under crowd. I'm sorry, this is the reality of life. This younger generation, online dating apps are totally socially acceptable. There's still hesitancy. You know, you see someone that's 45 years old or 50 years old and they're like, I can't believe I'm doing online dating. I wish I could meet someone in person. Yeah, those people are not the future. The future is this 30 and under crowd that as dating apps become totally socially acceptable, like that's just how you meet people. Match.com is positioned for growth decades into the future.
You know, Mark, back in my single days, I used to justify Match.com and those types of things to myself by saying, well, I scan for stocks. Like I use these tools to find good candidates. Why can't I incorporate that into, you know, the rest of my life? And it was kind of a natural fit. So I get that, but now it also must be a lagging indicator that Mark is now off Match.com, right? Like you're no longer on there.
This is true. It's a true story. So
clearly, you know, I don't know if I'm really super long-term bullish now that you're off, but
yeah, but for every Mark, 3 people are getting divorced today. All right. So, you know, lots of, I mean, but it's serious. When you look at growth companies and you're building an investing thesis, you're like, where is this company in 5 years? Where is this company in 10 years? Where is this company in 20 years? And the growth trends that you see with the younger generation in the using of apps has been my convincing story as well. So it's all a question of how you want to play it, right? Now, when something's approaching resistance, like that $90, $93 level that you've seen a kind of a double top over time, I'm less hesitant to be like, oh, I'm going to get in now, right? So it's a question of how you want to play it. Love the secular growth story of Match.com though.
So obviously one that you're going to keep on your watch list, not just for trading, but also for investing, you know, and that's what earnings can do. I mean, it doesn't necessarily create an entry point, but it gives you clarity about the company and where they're moving.
That's an excellent follow-up point, Tim.
Yeah. You know, and where they're moving in the future. Let's keep moving through. GoDaddy, next one, Mark, that I had down, I wanted to talk about. Obviously, one of our old friend, you know, long-term friend of of our community, Christian, great coach Christian Sisson over there. He called him Die Daddy. He hated this company. But GoDaddy here, Mark, what did you see in the data here? And then I'll get Matt's take on this one as well.
No, GoDaddy has been one of those companies that a lot of people have had the sneaky under the radar plays of the stay-at-home stock. It's not like a frontline play, right? You don't hear any of those frontline, hey, you know, it's Clorox and this and that. But GoDaddy is one of those companies that as more and more individuals work from home, right? More and more individuals are putting confidence in their online presence. And that's one thing, if people pull back in business, that the main argument people have been making on GoDaddy, and I think it's a reasonable one, is that, you know, businesses are going to cut in a lot of places, right? They ain't going to cut their domain names. They're not going to cut some of the core elements of server. I mean, there's some things that where business cuts just don't seem like they're going to be on the front line of business cuts. You know, like there was an analyst came out on Salesforce and Workday and said, hey, these people could have revenue problems as businesses look to cut back amidst a recession. GoDaddy, the argument, the sentiment has been that that's not the case. So, and I don't believe they have earnings until after the bell.
You know, the one thing about this company, we talked about Shopify and how clean the technicals are. That's an ugly chart. I can't remember the last time I prepped a trade on GoDaddy because quite frankly, it's always in the middle of moving averages, congestion. It has volatility that is not as predictable and not as clean in my opinion.
It was a nice bounce off the rising 20 though. I mean, we talked about this yesterday, that rising 20, there's been a lot of clean bounces, a classic retracement signal, a lot of clean bounces off that rising 20.
Give me Wendy's next if we can. We mentioned them a little bit. Wendy's, they had their earnings. I know fast food has been on your radar, Mark, here for quite some time.
Isn't it always on his radar?
And Noah, you went to Wendy's recently,
I
right?
did. I went to Wendy's recently, and they had a sign on the drive-through marquee that said, not available on the single. Like, it was trying to discourage the people from buying the hamburger. So of course I got the chicken sandwich, right? The spicy chicken sandwich.
Mhm.
Delicious. But yeah, I've read the reports, and I've actually seen it at my local Wendy's where that supply chain on beef might be breaking down a bit.
Mhm. Fast food makes more sense to me than restaurants. Mark, were the numbers with Wendy's okay here? What did you read?
Yeah, no, they
earnings?
were really good. I mean, the main problem with Wendy's, and I'm kind of hoping that this happens, is that for some reason the meat shortage causes this like algo-driven, trader-driven news sell-off, where you can get a deeper pullback on Wendy's. The numbers were really good. The breakfast sales were actually represented, I believe, 8% of their April sales or something like that, came out in the earnings call. So like the numbers on Wendy's, like Wendy's, there's been a couple things that I hated that I missed on when there was the dip. Yeah, I was a proponent when Wendy's was hitting bottom, selling naked puts at lower levels, but I didn't actually pick up any shares. Silver and Wendy's were two of the things that I regret the most, just because it just feels like this weird safety play. Now, obviously, I wasn't alone. Wendy's skyrocketed, went up like almost 3 times in value over this time. And so can't cry over spilt milk. Shoulda, coulda, woulda in the past. How do I want to play Wendy's today? I would really like Wendy's on a pullback. And so I'm hoping the beef shortage causes something of a significant pullback where I might be able to pick it up in the $13, $14 range. Once again, all you can do is map out what you want to do, right? Maybe it happens, maybe it doesn't, but mapping out a scenario where I could look to potentially acquire shares there, I feel really confident with. We'll see if it happens or not. Stranger things have happened, right?
Mm-hmm.
But that's what I'm hoping for on a Wendy's. I just hate, because once again, the numbers were decent, right? But we're still at numbers that were over there in the last 6 months. It's not exactly a screaming deal at $20, the share prices. And so I'm greedy. I want a screaming deal. Listen, I want to be at one of these many liquidation sales that they're going to have for closing stores as the whole world liquidates and goes bankrupt, right? So you look at the retail, what was it, Lord and something closing 37 store, Neiman Market. Listen, if you want cheap liquidation sales on clothing, wait for later in the year when half of the retail sector has bankruptcy liquidation sales on their storefront.
Yeah, the retail thing. What was the name of that retail? Because I've never been to one of those, Lord and Abbott or something like that.
Yeah, they're not going through bankruptcy. They're saying we're done.
We're out. We're out of business.
Done.
Yeah. Yeah, we're it's one of those going out of business sales.
And for all of you real estate investors and commercial real estate out there that think your real estate is a great investment and is foolproof, wait till you see tremendous amount of two things happen. One, retail stores closing because we are in a tremendous apocalyptic event for retail.
Go stay on Nordstrom's, Noah. Stay there for a second.
And two, as more and more companies, who was it? It was Bank of Montreal in Canada came out, and this is the thing that should what Bank of Montreal said should scare the living bejesus out of every commercial real estate investor that believes your cash flow, that stocks are stupid and the commercial real estate and cash flow. Bank of Montreal was like, hey, one thing we've learned about this market environment is that our workers surprisingly work very efficiently from home. And that business trend that COVID-19, if COVID-19 went away tomorrow, businesses are like, we don't have to spend as much on office space. We can have this very quasi telecommuting, maybe an employee works a couple days in the office, maybe we rotate in the office, but the need for office space is going to be an expense that businesses have learned they can trim down on, coupled with the retail apocalypse that is on our doorstep. Just get used to it. A lot more office space, a lot more retail space is going to be available. And that's if COVID-19 magically goes away. Imagine if a second wave hits. Yeah, commercial real estate investors, learn how to trade. In fact, if you're a commercial real estate investor out there, send me an email. I'll get you set up with a special trial, because your world's about to change in a dramatic way in the coming years, and you're going to need to supplement your income some way.
how do
Learn to
they-
cash flow.
How do they email you? How do they
I feel for you, right?
team
Because-
at tackletrading.com, right?
Yeah.
They don't, yeah, for sure. I mean, here's the thing. There's so much changing. And the reason why I had you stay on Nordstrom's here, they're closing 16 locations. Airbnb cut 20% of their staff. Matt, you told me earlier, Uber was firing some employees. There is a huge split.
J. Crew bankruptcy.
I mean, guys, the fundamental impact on certain sectors and industries is being felt immediately, where this hopium rally in the tech sector, Microsoft, Apple, Google, Facebook, it is holding this market up. So we are starting to see some of the economic impact, Matt, just not in the big tech names, quite frankly. You know, you're seeing it in some areas of the market, just not others.
Well, speaking about real estate, you know, I agree with Mark that I'm concerned about real estate in general. I don't know how things are going to respond 6 months from now from an economic perspective. But if there's one thing that I'm more concerned, I'm not as concerned with you know, residential, you know, properties as I am commercial property. Commercial property could take a big hit. They were at high valuations even before this.
Mm-hmm. Yeah, no, it's a really, really good point. We even saw it in the REITs, right? The split between which REITs actually took it on the chin and have not recovered as well. A couple more companies for me here, guys. Beyond Meat, I know it's one of these, you know, kind of just FOMO kind of hype stocks and whatnot, Robinhood type stocks, but they did come out with pretty good numbers. Mark, don't you think? Did you see the Beyond Meat numbers?
Did they make any money?
They let me look here. Beyond Meat earned 3 cents per share, so they did turn a profit.
Which is something for Beyond Meat, right?
Yeah.
Fake meat, real profits. Woohoo! Yeah.
In fact, it was a surprise jump. All right. So whenever you have growth companies, and this is the Wayfair, whenever you're a growth stock, like these companies are really, really popular amongst traders, right? And even a certain class of investor. Revenue jumped 141%. All right. 141%. Gross profit, they actually made a little bit of money. They did suspend full year guidance, right? So let's not get ahead of ourselves into the new vegan vegetarian movement is going to take over the whole world. But it wasn't terrible. And I am a Beyond Meat critic as far as valuation. This earnings report was somewhat reasonable. You know, I mean, you got to be objective, right? You got to look. Now, I'm not going to go buy any Beyond Meat right now. But if for whatever reason we have those type of sell-offs, I'm more prone to trade it to the bullish side than I've ever been before. And if you're looking for a momentum trade, draw a nice line there at the previous resistance level of 2020. You know, draw a resistance level where the peak's been in 2020. It's just a little north of here, right? So if you have a setup where you get a little high base, could you draw a line there, you know, on those?
Right there at about 130.
February?
What 130-ish right here?
Yeah, that, you know, like, so, I mean, if you get a nice little trading setup here, there could be a nice little trade in
Hold on,
Beyond
time
Meat.
out. That was the laziest resistance line I've ever seen drawn in my life. You want to talk about resistance as a zone there?
I did it better. That's that's the best resistance
We're
line
now
I've.
calling that a breakout.
If I draw my line just right, Tim, it is a breakout, right?
Sure.
There.
Yeah, actually it was out of that. Anyway, Mark.
All right, everybody ignore everything that just happened in the 15 seconds. You know, there is a resistance level there, and you could have a really nice bullish trade setup develop over the next 4 or 5 days, or maybe a couple weeks, right? You don't get to decide when the trading setup occurs, but there is a clear resistance area there, and there's a lot of clear area to the upside. So you don't be surprised if we're here talking about Beyond Meat from a bullish perspective here, because if I think it wasn't a terrible, well, Robinhood investors are already counting Beyond Meat at $325, right? So
yeah. Well, it's so much more tradable now than it was back during the IPO days. Like the bid ask spreads are normalized, the option volume. I mean, for a while there, it was untradeable, and I kind of put it off my radar just because of that. And then it got its typical IPO correction where, you know, rallied up and then it sold off. Now it's found a baseline. I like a breakout on it.
It's still untradeable to me. The longer you guys talk about this, the more I want a steak. I'll be honest.
Well,
Well, like we were saying in the chat, pay for that steak by
let me see
trading
if I
Beyond
can
Meat.
sign you up here, T.
Okay.
For the first time, Beyond Meat has tested its 200-day moving average and actually broken out with some strength on some volume there. You have a momentum candle where on the cash open, the investor class didn't sell it on their numbers. Their numbers weren't bad. And then the traders bought it up above that 200-day moving average. You can, if you give me a little consolidation between 125 and 130, testing that breakout
all
channel,
I want.
form a little bit of high base at that 130. I would miss out on it if we just go straight up above.
Yeah, we're going to miss out on that, right?
Yeah, just would. But if you go back to Coach Frank and how he approaches those breakouts, you test that 130 mark, you consolidate on that 130 mark. Maybe you form a little bit of a high base. Maybe you form a little bit of a bullish flag pattern. You could absolutely map out a really good trade with the trigger above 130, stop loss underneath that base, maybe at 125 with the target of 150 to 175. And you could absolutely momentum trade that. Again, if it just V shapes and just momentums and goes up, 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 that's just something that we're going to miss out on because that's not how we approach the marketplace. We like high probability setups, but that would be a high probability setup.
Will you pull up Shopify, Noah, for me? I would love Beyond Meat to do what Shopify did before its breakout. Take that. What was that? 2 weeks
Exactly.
off? Like if it gives me this type of pattern, now once again, you don't get a trade. Like, listen, maybe Beyond Meat just goes to 205 trading sessions and I miss out, right? No big deal. There'll be other trades in the future. You give me this pattern, Tim. If you give me this pattern with that earnings report, with 100 and a gazillion% year-over-year growth, with a stock in a momentum environment, these are the type of companies that are killing it right now. Now, I'm still going to wait for my pattern. I'm not going to trade blindly. You give me Shopify pattern and you don't trade it, Tim, I am going to mock you from now till the end of the year, every day.
Well, to be fair, you're going to find something to mock him on. But I will say, looking at that 9 EMA right there, Shopify got overextended in the short term. It consolidated. The 9 EMA caught up to Shopify. And then obviously on its earnings, it had some good numbers. It broke out. But if you consolidate over the next week and a half between 125 and 130, and you have those moving average start to catch up, the 9 EMA goes above the 200-day moving average. Watch that 9 EMA kiss. Watch the stock price kiss off that 9 EMA in a high base type scenario. And if you can't sign up for that momentum trade, you can't sign up for any momentum trade.
No, definitely. If you let it marinate for a while, it might actually make it taste good.
So are you on the team now?
No, I was going for a vegan burger joke there. Just didn't land.
as probably the only man here that actually does eat vegetarian burgers, I'm telling you, they're not that bad. Now, Beyond Meat is not my favorite of the bunch in terms of my personal preference, but they're not bad.
What's the one Burger King uses? The Impossible Burger? I think
that's a Beyond Meat product, isn't it?
No.
Impossible Burger is something else. The brand I have, I don't even know what the brand name is. I just know what the bag looks like when I go to the store.
Sure.
But those black bean burgers, put a little garlic salt on it. Oh yeah.
And Trump and the administration needs to knock it off with the China stuff, because COVID-19 was started in a Beyond Meat lab in order to infest all of the meat producers so more people would talk and use Beyond Meat. That is my working conspiracy theory.
That is one of the better conspiracy theories I've heard in the last 6 weeks.
Is there tinfoil in that beanie? I showed you that beanie. Is that it? Did you buy it?
Listen, all I know is give me the setup on Beyond Meat and I'll place my first bullish trade on Beyond Meat. Listen, these cult stocks. This is why I was talking about.
Gotta respect them for sure. Yeah.
These cult stocks can move because the people that love Beyond Meat, you don't think Beyond Meat is on Robinhood radars right now? You don't think the Beyond Meat people are saying, all right, 250.
Mm-hmm. Let me throw a mark.
I think it might be on more radars than Robinhood, though.
I'm going to throw Mark a bone right here. Look up DKNG right now. Have you seen DraftKings today, Mark? Breakout. See, but you got to follow your rules. You're more of a gambler with stuff like this. You'll go with your instincts and kind of fly by the seat of your pants based on your old gaming theories and
I'm
whatnot.
telling you
I
right
don't play
now,
before.
this is what I talk about DraftKings. Once again, I only bought like 10 shares yesterday, right? Like, so what, I'm up at like 4 cents or some crap like that. But DraftKings is a company I would love, and this is, it's about how you want to build a position, right? Because DraftKings is a type of company that could irrationally be at 100 bazillion freaking dollars because it's a cult type stock. Now, ideally, what I would like to happen is DraftKings sell off and I pick up some shares at like 13 bucks and then more at $10 and stuff. You don't always get to choose what you want, right? But if football opens up, and I'm telling you right now, if football opens up on DraftKings, I don't even know where it could go. I know a cult stock when I see one, and DraftKings has cult stock written all over it. Now, I hope it pulls back, blah, blah, blah. But I'm so tired of being right and never getting my pullback, right? That's why I'm always selling naked puts on gold. This is a cult stock in the making. Give me a sell-off. Give me a sell-off on this, please, so I can add some more shares.
Not touching it myself. Peloton next. So you want to talk about cult stocks? I think this has become one, guys. You're now hitting
100%, right?
You're now post earnings hitting a 52-week high. In fact, their all-time high since they IPO'd. I mean, I'm much more interested. 3 earnings seasons in, you've got a stay-at-home kind of stock, Matt. They do a subscription and products for people who are going to be working out at home. Where Planet Fitness today came out and reported terrible earnings, obviously because the gyms are closed down. Peloton's been killing it. So much more interested in a stock like Peloton on momentum than a DraftKings pre-first earnings report personally. Matty, what you read here on this chart?
A nice little breakout. We have earnings hasn't been announced yet, right?
No, it wasn't it?
No, I don't think it has been.
Check that date. Oh, my eyes deceived me, brother. Good catch on that.
Earnings hasn't been. So let's put a little pause on that for a second.
Yeah, let's wait on that earnings report. It looked. I thought, was that after the bell today? Noah?
It's after.
We'll talk Peloton tomorrow, though. But then why are we breaking out pre-earnings?
Well, I mean,
why did Shopify break? Because this market has been the easiest market. There are a handful of stocks that people like, right? And there ain't very many. They don't like Wells Fargo. They don't like the airlines. They don't like Caterpillar. Most stocks people don't like. The ones they do have been killing it this week. This has been what are the 50, 75 stocks that we love? Maybe not even that many, right? And the Microsofts, the Shopifys, the Facebooks, the Apples, the Pelotons, the Clorox, the Netflix. What are the stocks we love? Those have been killing it this week. Now, how sustainable are they? But I think this is the type of week that when we get a pullback in the market as a whole, right? Or when some of these stocks, people love these names. Now, they might change 4 months from now, right? But they love them today, and they'll love them probably for the next couple months. And so those trade setups on stocks that are doing this great, pull up that heat map again. Stocks that are doing this week, make a watch list that says first week in May. These were the stocks people loved. And that is going to be my bullish trading list for the rest of the quarter. Like, they're not going to stop loving Peloton. They're not going to stop loving Clorox.
By the way, we
Microsoft.
It's very exciting for me here, and it's a moment I have to acknowledge. We just hit our high water mark on live views here on YouTube. Appreciate everybody for being here. Our show is growing. Kick the 400 number by the time pretty soon, Matt. We'll be kicking 500 and 1,000 and all those kind of things. Really, really cool out there. If you're watching our show for the first time, subscribe, click the bell, come and join us each and every day. I do have
terrible Fibonacci number on the likes, though.
It's terrible. Give me that thumbs up, guys. If you're watching the show right now, click that thumbs up button. Make sure that we get the analytics out there. I think it does help. And we love you, Google, for sure. I think we've been kissing Google's
Google and
for a
YouTube
while.
are the best. Maybe we'll get 500 by the end of the show if we keep talking about Google and YouTube being so awesome. They are amazing. You should buy Google. Let's bring up that chart right now.
It's so funny. We just had 15 more people join when you started talking Google.
Go to New York Times. One company that I don't think you should be like all goody about just because they are doing well.
NYT, no, NYT
is New York Times.
Man.
Like the one area of the market that I think is going to have a little hard time moving forward are the ad growth companies. Companies like that aren't maybe one of the streams. Great big number. Make no mistake, their earnings report was not as good as it looked at. Ad growth companies, they're going to have a hard time moving forward.
Mhm.
Like, you didn't see real growth in revenue, only 1% year over year, right? New York Times is not a growth story. New York Times is not a cult stock. And they pointed towards significant, massive ad revenue problems in the second quarter.
Mhm.
So, like, just because a company is up after earnings, it takes a little bit of digging into the numbers and putting it into an overall thesis. Make no mistake, New York Times, not your Peloton, not your Clorox. They pointed towards huge, tremendous problems in the second quarter, right? So I wouldn't get fooled by this green candle at all.
One more for me, though, I did want to point out, look at Love, Southwest Airlines. I mean, we keep talking about these momentum plays. I got to put a little bit of cold water on all this because there still will be bearish opportunities in these underperformers. I mean, we highlighted Love's earnings a couple weeks ago. We talked about that support break. Matt, support break, the stock is down another $5 off $30. That's 15% just a few days. So underperformers, areas of the market, they can fade quickly when the charts start to break down. I mean, airlines are really still in trouble, don't you guys think? Obviously, the statement of the
Well,
day.
I mean, there was a report that came out today that airlines are bleeding about $10 billion in cash per month. But what was a devastating number, in my opinion, was they're only averaging 17 passengers per domestic flight and right around 27 passengers per international flight. And then the airlines came out and said, if we refund all the people that want to refund on tickets purchased in the future, we're all going to have to declare bankruptcy. So not exactly an area of the market that anybody should be focusing on. And we've been talking about shorting airlines for a while.
Yeah, definitely that breakdown was pretty clean. All right,
We
guys.
live in a world where you might want to make a bullish trade on Beyond Meat and you might want to sell Southwest.
Stock
That's
pickers
the
market.
new world you live in. It's a stock pickers market. It's a stock traders market. Now, Matt, I want to get your take on one thing. So financials getting killed, right? Airlines getting killed. Can there truly be an economic recovery that sustains all of the other nonsense we're seeing in price action if those two groups of companies, banks and airlines, don't stabilize?
No,
You know,
especially the banks.
and so, like, it's a disconnected market this week. Trade
This
accordingly.
this market has disconnected from all economic semblance of reality completely. And again, maintain the short-term bullish thesis in a lot of these stocks, and they can trade longer bullish than anybody can even fathom. But at the end of the day, until some of these other sectors start participating in it, and until we start to see economic data actually come in, I think people should be cautious from the investing perspective and trade the short-term price action.
Yeah, and I guess the big thing, because I'm not going to go chase price. If I catch a breakout, I can catch it, right? But I'm not going to go chase price. What I am most excited about is what we've identified this week as far as those beloved companies where people really love. And let's say we have a huge market sell-off for 3-4 days. I think there could be a lot of good trading steps in your Microsoft, in your Shopify.
Oh, absolutely. 100%. You're always going to trade the technical condition, always 100%. But again, how many times have we had to say this in the last 6 weeks? Investing is different from trading. Trading, you're going to focus on trends, patterns, momentum, indicators, volume. That's what you're going to be focusing on. Investing, you're going to be focusing on increasing dividends. You're going to be focusing on economic data. You're going to be focusing on valuation. So it is a completely different form of analysis when you're talking investing for the next 10 years versus trading for the next 3 to 5 days.
Yeah, I agree with all of those things. Guys, we are going to start wrapping this one up, and a couple things we got going on tonight. I do want to make an announcement in the chat. Just somebody type in 7 p.m. Eastern. live webinar on 5G stocks. And that's going to be with Coach Gino. Got a lot of interest in that. Obviously, 5G is a big topic. We did a blog over there on Tackle Trading today, kind of highlighting where that webinar is. If you are not a member of our community, Mark, explain our 15-day trial if you can.
Listen, we do this halftime report in which we go over the big stories of the day. For you people just watching for the first time, we break down every day at 12:30 and we go about an hour and a half. We break down all of the big stories, the big things. And then we have a pro service product, a team of Tackle Trading, that we give away a free trial for, in which we do a ton of education to learn how to trade these setups. And then we have live programming all the time. Now we're going to do a live show here on YouTube where Coach Gino, and he is the most likable out of all of us. So if you like us, you're going to love Gino. He's just a likable guy, decades of experience, going to go over 5G stocks and what you should look for in the 5G movement. That's going to be at 7 o'clock here on YouTube, live, free for everyone. And then I believe, Noah, you are going to go over with our pro members, the Tackle 25.
Yeah,
covered calls.
I'm super geeked out about this 5G Palooza thing that Gino's doing. And then after that, that's going to be a tough act to follow, but we're going to have a lot of fun talking about our Tackle 25 value investing, conservative covered call type stocks that they're pretty sustainable for your long-term trading and investing strategies, but you want to catch both. So make sure you go sign up for the free trial. You can catch us on, again, the YouTube channel here at 7 p.m. Eastern. And then we'll be doing the Tackle 25 again. That's at 8:30. So we'll have a little time between the two shows.
Yep. Awesome job, Matt. Last thoughts.
Any webinars we put on, either the special webinars we do on Wednesday night, or obviously our pro member webinars like lounges and traders lounges, coaches shows, mastermind groups, which is what Noah's putting on with one of our systems called the Tackle 25 covered call system. Those can be found on the events page at Tackle Trading once you do sign up.
No,
go ahead, Mark.
Companies that I'm looking at in earnings in the next couple of days, and this is going to be, we're going to talk about a lot of these tomorrow. Carnival Cruise Line, we're going to talk about cruise lines tomorrow. We're going to talk about PayPal. Where does PayPal fit into all of this? We're going to talk about PayPal a lot tomorrow. Earnings that come out tomorrow. You got Bristol Myers Pharmaceuticals seems to have been really, really steady lately. We're going to see if that's going to continue. So cruise lines, Roku, another cult stock, right? We're going to talk Roku, and then Ubers and Yeti Holdings. I love these cult stocks. If you're under 30 and you have strong brand recognition, listen, I'm all about losing a couple decades and getting some hair back, and jumping on some of these coal stock plays. So Yeti and Uber, we're going to talk about tomorrow. We could talk about PayPal. When did PayPal become a boring old fuddy-duddy stock?
About 3 years ago when I put it on the Tackle 25.
Yeah, and then we talk about Dropbox. So some real interesting names over the next 24 hours. We'll talk about them all.
Awesome job here today, guys. Make sure you click subscribe, click the bell, come back and join us tonight, 7 p.m. Eastern, and then every day here on this halftime show, 12:30 Eastern, guys. We'll be back then. See you then. We're out.